Hello, hello, hello. You are live. Look at that. We get a little "you are
Holy
live"
nice.
message now from StreamYard. Isn't that nice of them?
What you know what?
But
I think we missed our whole first bumper. Gee whiz, there's crazy things happening today.
nice. Outstanding.
So what's up, Judah? Let me hold
Not
on a second.
not much. Yeah, you gotta close the
I
door
got all
there.
kinds of stuff going.
Oh,
I mean,
we missed the our audience missed our wonderful, sexy, amazing opening bumper. That's too bad.
I know it's insane.
Sorry.
Well,
Tune back in tomorrow for our opening bumper.
exactly. We'll have something else. Yeah, big day today, man. Big day.
Yeah,
We got a
lots
lot
of lots of
to talk
lots of
about.
lots of stuff to talk about. So let's just jump right in. My name is Judah Hoover, and this is Josh Weidman. We are the co-hosts of the Build and Grow with Real Estate show. I am a real estate agent with State House Group, and I want to be your realtor. Who are you, Josh?
Yeah, Judah, I'm having some technical difficulties. Give me a second here.
I'm
All right,
seeing I'm
my
seeing
name's
that.
Josh Wyden. Oh, gee whiz. Are you? I mean, how's my connectivity?
You're
All
you're
right.
you're, you're
Yeah, this is
not
amateur
awful.
hour here on the Grow with Real Estate show. My name's Josh Weidman. I am a hard money lender right here in Central PA. I've been a real estate investor for the last 14 years. If you are looking for funding on your next deal, I want to talk to you. And frankly, you want to talk to me. We are a direct lender, which means that we're able to move very quickly. We can underwrite your deal in just a few hours and give you an approval same day. And then we can close within 24 hours of approval. So long as your ducks are in a row, title work's ready to go, we're ready to close. So give me a ring, 717-213-8488, or you can check us out at hardmoneybankers.com. So yeah, Judah, crazy things happen in the world, really good stuff. I mean, I saw something the other day that interest rates are somebody was offering a 30-year fixed at 1.99% for a 30-year fixed mortgage, which is pretty crazy.
Yeah, it's
Um,
funny. It's funny because I wake up every day, and besides doing all the spiritual stuff and despite all the other stuff, I make it a habit of reading Facebook memories, because Facebook memories are a great way to just like my diary. And I saw that I had shared a post from a friend of mine from the industry, Paul Kraus. He runs Red White Rose Title down in New York. Are you familiar with them? Great title
yeah,
company.
yeah.
And my boy Paul posted that interest rates are at 4% and looking to go below 4% shortly, and that was 12 months ago. We were talking about 4% interest rates for 30-year fixed mortgages, and how crazy that was.
That is insane. I mean, now we're looking at no. Pretty soon we're going to be at zero or better. So I mean, there's crazy stuff happening today. Okay, so Monday through Wednesday, typically we do education, right?
Right.
Thursday we have a guest on. We had our schedule a little bit screwed up with the start of the new school year, some other obligations that we had planned for yesterday. So we scheduled a great guest, Jonah Hoover Green was down here yesterday. She did an amazing job, and we had a lot of people and some really good feedback coming in there. Today, we're going to pick up where we left on Tuesday and jump into identifying neighborhoods that match your exit strategy so that you can maximize your marketing dollars, and not spend money where you don't need to, and then, blow it out in the areas that you do. So let me bring this up here. I'm going to share this screen if I can. 1 second here. All righty. Beautiful. Okay. So we're going to jump in. Now, one thing that I want to cover today, the first area that we're going to look at is cash flow, and frankly, I think wholesaling deserves so much time that I don't think that we're going to cover it today.
Right.
I think we're just going to focus on this cash flow case study. First of all, I want to say thanks to everybody also who's been jumping in and commenting. Yesterday, I got a really I got my t-shirts in for Hard Money Bankers t-shirts. If you are looking for a t-shirt, give me the best comment. We're giving away either a t-shirt or a copy of my book, Property Hackers, to the best comment of the day. So let us know what you think. We're seeing Steve and Taz and Bayshore. I mean, you guys have been jumping in and commenting like crazy, and we love it. So anyway,
the other thing that we want to talk about is we're not diving into wholesaling today because Josh and I have been planning and are working on kind of like a webinar wholesale event where we are going to probably do a 2 to 3 hour event with multiple regional wholesalers on there talking about how they do what they do and what things look like, and talk about the real nitty gritty of how to run a wholesale business and how to be a wholesaler. If that's something that would be interesting to you, if you think that we should have a wholesale event and that you would participate separate and apart from the show, please go ahead and comment like Bayshore just did right here. Thank you very much. Definitely getting some comments there. So if this is live, if you're watching this later and you are interested in something like that, let us know, because Josh and I are thinking about whether we should try something like that and whether or not that would be valuable.
Yeah, absolutely. So Judah, holy cow. All right. So just as a little bit of context, we brought this up because I've seen a lot of people sending me deals that they might be good deals in some situations, but certainly not for the exit strategy that people are talking about. Right. So we want to kind of focus on, depending on what you're gearing up to do. If you're trying to look for a fix and flip property, you're certainly going to be looking in a different location than if you're looking for a cash flow deal. Right. Today, we're going to focus in on cash flow and kind of look at the characteristics of the types of neighborhoods. And from there, I want to take a look at how to evaluate those type of deals in a real world scenario, so that, you can look at it and say, okay, if I'm buying on the 1% rule, which we'll cover in a second, or the 2%, what's that mean to my bottom line? What should I expect to see in my pocket at the end of the day here? All right, so let's jump in and just get started with, the first thing we want to look at are the characteristics of these type of neighborhoods. And we can do this by, look, whether you are in central Pennsylvania and you're going to take notes here, and then I'm going to start seeing mailers in my mailbox, on my rental properties, or you're in Timbuktu and you're trying to find a template to find your next, rental property. This is the type of template that you need to look at, right? These are across the board numbers that you want to look at and use as, general characteristics for the types of areas that you want to be investing in, right? So first and foremost, let's talk about the 1% and 2% rule. This is pretty simple. This is essentially, you're looking at the monthly rental rate as a percentage of the total cost of the project. And we're talking about acquisition and construction, right? So if you're looking at a $1,000 a month rental and you want to adhere to the 1% rule, which a lot of people preach as like, that's where you want to be. You want to pay $100,000 for that property.
Right.
2% rule, really simple. Same kind of deal. The rent should be 2% of the acquisition costs, acquisition and renovation costs. What do you think about these numbers, Judah? Because we're going to look at.
I think that they are really good for understanding a market, and for they're kind of like a sifter. You know what I mean? They're kind of like a filter. It doesn't mean that there is a deal there. It just means whether there's a likelihood of there being a deal there, right? So it's just like, oh, old lady Johnson down the street, her house is in disrepair. Doesn't mean she's a motivated seller. Oh, Bob Smith over here is 2 months behind on his mortgage. Doesn't mean he's a motivated seller. However, if you can take somebody who's behind on their taxes, there's disrepair, and they've got equity in their house, and they've owned it for a while, and you can start layering up these things, then that means that it's good. So when I am looking at, let's say I want to look at all the 3 units in Lancaster, and I get a list of all the 3 units in Lancaster City, and there's like 30 of them, let's say. Well, I just can quickly look at gross rent and purchase price, and I'm looking for which ones are above 1%. Those are going to be the ones that in my first round I do my numbers on. Those are the ones where I try to do my numbers on. In some neighborhoods, if you are seeing that almost every deal you come across in a neighborhood closer aligns with the 2% rule, just understand, for good or bad, you're in a D or an F quality neighborhood. And maybe that's where you want to be, and maybe that's not where you want to be. But there's a reason why the rent is closer to 2% on a monthly basis of the value of the property than 1%. So these are clues that I look for. And these are indications. And thank you, Bayshore. Yeah, we try to give out real gems here. We try to only tell people there's a lot of flim flam and fluff out there that people talk about in podcasts to make it sound like they know what they're doing. Josh and I have actually been doing this business for about 20 years each, and so we only talk real numbers, not what actually sells courses.
Yeah. I want to do a pile on of what you just said about different types of neighborhoods. So I had a discussion on Monday. I was talking to a broker or a real estate agent that was looking for some deals for their clients, and they specifically were talking about multi-unit properties. And we were talking about operating expenses, right? What's the average operating expense that you calculate in when you're looking at cap rates or you're looking at return on investment, things like that? And we're going to do a deep dive, and I'm going to show you a spreadsheet that I use to calculate and analyze my my single family and multifamily rentals. But one thing that most people overlook is that your operating expenses, they're a heck of a lot higher than you think they are. And when I say operating expenses, I'm not even talking about your principal and interest payments to your mortgage company.
Right.
But there's a lot more that goes into expenses than just simply, you've got your taxes and insurance and your mortgage payment. Like, there are real expenses that will come along with this, and they can range as high as 50 or 55%, depending on the age and condition of that property. And so, when we talk about a 1% rule, 1% might work for a new construction house, but good luck finding a new construction property that you're going to get, a 1% return every month on your.
Usually what you're going to find is, a house will cost you 160 or 180, and you can only rent it out for 1,400 or 1,200. Right. So you're at like you're at like 0.8%, 0.75%. And that's going to be really hard to cash flow. Now, I work with investors and I manage their property where that's what they want. They want those $200,000 houses.
Mm-hmm.
And then they put 20, 30, 40% down on them so that they cash flow. Because they know they're going to get and when you do that, when you buy a $200,000 house, right, and then you put 40% down, you're at about 150,000 into that, and so you're renting it out for $1,500, $1,600, $1,800. You're actually above the 1% rule if you look at it that way. So there are a number of ways that this can work.
Well, so here's I'm going to take 3 steps back instead of 1 hit this time. So Judah, we talked a couple weeks ago, and it's more than a couple weeks ago, a few months ago, about different types of returns and what you should be comfortable with and what kind of returns are good and all that stuff. There are some people that they want to just keep their money safe, right? You see these people buying $100 million condo in New York City. These are people that they have their money overseas. They're maybe in a country where their money might not be so safe. They want to put it in a location and an asset where that it's not going to lose 75% of its value overnight, right?
Right.
That's not my way of investing. We're talking about today people that are looking specifically for a cash flow return. Not even, we're not talking equity spreads. We're not talking, improving neighborhoods or uptrending markets. We're talking about cash flow returns. So when we look at the 1% rule, one thing I've learned over time, and if you go back to 2008 and you look at the price points of where things kind of bottomed out after everything kind of shook out by 2010, the 1% rule is a good way to find the innate value of a piece of property. If you're looking for a bottom, look for that 1%, because typically 1% means you can cover your mortgage, cover your expenses, and you can walk away clean, and it's not always the case, but typically that's what that looks like. You want to be much more aggressive in your percentages if you really want to make money and you want to put money in your pocket every month. So we're going to look in areas when we're looking at these type of properties, we're looking in areas that are going to be at least a 1%, or that you can buy at least 1%. Doesn't necessarily mean median home price and all that, but there's the opportunity to buy properties at 1% or better. You're looking in areas that are typically about 40 to 50% non-owner occupied. Once you get into 60, 70, 80% non-owner occupied properties, you're running into issues with maintaining values. And you can manage those properties yourself or hire
Those are
somebody
C to D quality properties. Anything that's more of a rental neighborhood. I do not in central Pennsylvania. Let's put it this way: in central Pennsylvania, I cannot think of any neighborhoods or any areas where the rental rate is above 50% and it's not a C quality neighborhood. Now, in Manhattan, there's places like that all over the place. You know what I mean? But that's, the old adage is so true. Real estate is location, location, location.
Exactly. And so you're also looking for, if you want to make this easy for yourself and easy to find a tenant, look for areas where the median income is equal to or greater than 3 times your annual rent. Right? Because again, you're going to be, that's one of the qualifications you're going to be looking for in a tenant. 3 times the rent as their income minimally, right?
Right.
Okay. So now let's look at a case study. Come on, technical difficulties. There we go. All right. So I went back and I looked at Palmyra, Pennsylvania in 2017. And if you were looking for a rental grade neighborhood in that time frame, this is the place to look. I used a bread and butter property, 3-bedroom, 1-bathroom, or 2-bathroom house. Okay. Average square footage, I think, was 1,400-ish square feet. The median income in 2017 was $57,698. Median rent for a 3-bedroom house, $1,495. Okay. The median sales price at that time, oh my gracious, I did my math and on a different number. Median sales price, it was $178,900. Owner occupancy, 56%. Okay, so we've got roughly 44% of occupants are tenants. We got a B-class neighborhood, and we're looking at a rent-to-value ratio based on our averages or our median numbers of just under 1%.
Right.
Okay. This is perfect because how many investors that are doing their own marketing are paying retail for a property? Not many, right? And the discount that you need to get to that 1% or even 2%, it's not so bad.
Right. And you definitely at these price points you're going to struggle to get 2%, and I would worry if you were anywhere close to 2%, but you're going to get close to that 1%, especially when you figure and consider that you are going to be getting a little bit of a discount when you purchase. You're also that median rent takes into consideration a bunch of lazy old tired landlords who haven't raised their rents in 2 or 3 years and are way below market as well. So you don't have to push rent. You just have to get market rent and get a little bit of a discount, and you're going to easily be above 1%.
Okay, so I had to change my screen here. Just give me a minute. All right, now we're going to go and I'm going to do a screen share of an analysis here, a cash flow analysis.
So Brian, while you're doing that, but let me just answer Brian's question here. Do you want a higher or lower percentage of owner occupied? You want to be 50% or greater for owner occupied.
Yeah.
So we talked about this when we talked about classes. A class A neighborhood is generally going to, one of the characteristics, there are many, one of the characteristics of a class A neighborhood is it's going to be over 90% owner occupied. A class B neighborhood is going to be 75 to 60% owner occupied. A class C neighborhood is going to be 50 to 40% owner occupied. And if it is 40% or less, it's going to be a class D neighborhood. That is true for central Pennsylvania. And that's true in Harrisburg, in York, in Lancaster, in Reading, all across central Pennsylvania, kind of the 5 counties that make up central Pennsylvania. Now, listen, you might go to, some place like Lidditz and, point out a block or a neighborhood where, that doesn't exactly apply to that. Those numbers, there might be a little bit of wiggle room on either way. But ultimately, you want to be renting properties in a predominantly or more owner occupied area. That's where you're going to have more success, because you're going to have pride of ownership. With your surroundings, just owner occupants just tend to take better care of properties, and values tend to go up in value when they are occupied by owners as opposed to being occupied by tenants.
That's right.
And I understand that this sounds like French, Taz. Don't worry. Tune back every day. All we ask is half an hour a day from noon to about 12:30, and we'll get you speaking French in no time.
All right, so let's talk some French. Let's talk some French. And talking numbers makes my mind go fuzzy unless I have a physical example in front of me. And that's why I'm putting this up. I'm not going to deep dive this too much, but what we have here is a cash flow analysis. If you'd like a copy of this, feel free to email me at josh@hardmoneybankers.com. I'd be happy to give you a copy. I'll send you a
this is way more detailed than the whiteboard or big notebook pad that you usually see people breaking out for these types of things. Quality content is what you get here on Build and Grow.
All right, so we're going to start with the after repair value. We're going to assume that with our property, there's going to be no construction. We're just using the medians for our first example. Here we've got our that we can save some money there. We've got our estimated after repair value. We know what it is, $178,900. That's our purchase price. There is no builder's risk policy because we're not doing any construction. It's ready to rent on day one. Our closing costs here are going to be just under $5,000, zero in construction, leaves us with a total expense of just under $184,000. Okay. Includes all of our closing costs, everything. This does not include financing, however. We'll do that on the separate tab. If we have $1,495 as our median rent, okay, we're going to take out a vacancy rate based on losing 1 month's rent every time the unit turns over, and we're going to say the average tenant stays for 2 years. Okay, fair enough.
You're probably going to average 4 to 5 years on a property like this. So 2 years is actually low. Doesn't mean the first 3 tenants won't only stay a year, but if you own this property for 20 years, your average tenancy will probably be 3 to 5 years. So so doing your numbers based on every 2 to 2.5 years a flip is a good number to use.
Exactly. All right. So we've got an adjusted annual income of just over 17 grand. Now this number, it transfers up to the top here, expect annual gross income, 17,192.50. Now we have our expenses, and this is where things get really interesting, and there are areas where things matter. So in Palmyra, I happen to know that they just started a rental registration last year. And that's $50 a year. In this case, we're using this on 2017 numbers. There is no registration or licensing fee, so it's zero. There's no homeowners association, and we're assuming that the tenants are paying all the utilities. So there's zero for that as well. Okay. But we've got property insurance. We have property taxes. This is about 2 point. It's like 2.2% in this specific area throughout Pennsylvania. The range is pretty darn big. It can be anywhere from 0.9 to 2.47%. So I mean, it's a big range. You got to check for each property. Leasing, again, you might be a rock star and be able to find tenants with the snap of a finger that are great. If you've never done this before, hire a professional.
Yeah, that's
Hire,
a big expense that a lot of people don't take out. They take out the property management, but they forget that every property manager out there is going to charge a fee whenever they flip it. So that's critically important. So hurry up,
yeah.
Josh. Get to the point here. So net operating income after we take out all the expenses and property management and repairs and blah blah blah. We come up with $9,677.33. That's the NOI, or net operating income. When we
Right.
take that number and divide it into our investment into the property, we have our cap rate.
Yep.
Or the rate of return we're going to get on our money if we invest all cash. So if I invest all cash in the stock market and get a 5% return, or I invest in real estate and get a 5% return, 5.26% return, that's the same thing. I would argue even at that point, real estate's better because I'm also getting appreciation and I'm getting this income without actually having to sell the stock or without actually having to sell the real estate. But that's, peanuts. But that is your cap rate, is your rate of return if you dealt in all cash.
Okay, so let's do. I want to put an example in here. Now let's throw in financing, because how many people are going to buy this thing and not get financing, right? It's an investment property. Let's say that we're using financing. The average interest rate in 2017 was 3.99%. Okay, so we put that in there. It's an investment property, so we got to put 20% down. In this case, that means we're going to get a $140,000 mortgage, give or take. All the other numbers are going to stay the same, except this one right here, which is going to be our principal and interest. Principal and interest is almost $8,200 a year. Okay, that has a huge impact on our net operating income.
We shouldn't call that net operating income. That should be,
net cash flow. It's net cash flow.
Net cash flow, right?
Right.
On your other sheet, it's net operating income, but here you should call it net cash flow. Sorry.
Okay. So look, if we take this number and do the same calculation, and we say, okay, we have $43,000 net invested in this property, and we're only getting $1,500 a month. That's a 3.41% return.
Cash on cash return. So that's not your cap rate. That's your cash on cash return of only 3.4%.
Which stinks.
Yeah.
I'm going to tell you right now, it stinks. Let's go back here and look at this if we use the 1% rule.
Right.
Okay, let's say you negotiate this thing down, and we go back here and we say, all right, we got this for $149,000 and $500. Okay, this fits the 1% rule perfectly. And if we go over and take a look at the return,
but also look, you're go back to sheet 1 there, because your cap rate went from 5.25 to 6.26. So basically, you bought it for 6.29. So you bought it for 1% better on a cap rate.
Yeah.
Not a huge. You didn't buy it for 3% better on a cap rate or anything like that, but you bought it for a 1% better on a cap rate and used leverage. And let's look at what that looks like.
Okay, so this is a big deal. This is a huge deal. If we look at this, come on, there we go. We've got an 11% return on investment here.
Right.
11%. Now
that's a cash on cash return on investment. You're also, you have to remember, of that $1,400, what's your monthly payment there? What's your monthly payment there?
Oh, you know what I didn't do? All right, hold on a minute. I got to make a change. Because
you got it, because now your estimated value here goes down.
Yeah, hold on here. So we got to change the 149,500. Okay. All right. the point that I want to make on this is that you got to get a discount. You got to get a discount because even at 1%, you know, it's not terrible. You're just under 10%.
Right.
A 10%. If you took your $36,000 and put it in the stock market, and you got a 9.5% return,
that would only be realized by selling the stock.
Right, right. Only be realized by selling the stock. This is like a dividend, a 10%.
So this is a 10% dividend. You tell me what stocks you can buy that you get a 10% dividend on, and
Yep.
I will go out and raise money to buy it. The other thing you have to remember here is your what is your monthly payment here? Principal and interest. Why can't I find
The principal
um
68.50. The monthly
68? Yeah, so 68.50 a month. Hold on here.
60. That's a principal and interest, but you're
So a month that's $750.
yeah.
So excuse me, $570. So you got to figure that, roughly 200 to 300 of that is going to be principal reduction.
Yeah.
So that is wealth creation right there. Plus, this property is going to go up an average of an additional 2 to 3%. So by buying this normal property without stealing it, you bought it, it was 180, you bought it for 150 roughly. So you got a little bit of a discount. You didn't do any work to it. You bought a boring property in a boring neighborhood. You didn't get to brag to anybody about, some super awesome, sexy rehab you did. And you're getting a 10% cash on cash return. You're getting another 3 to 4% because of principal reduction. And you're getting another 3 to 4% because of appreciation. So you're doing a deal where you're investing some money, and what you're walking away with is damn near a 20% return on your money. That's why real estate is so powerful. You're getting, over the long run, you're getting a 20% return on your money. That's after you factor in vacancy and maintenance and repair and property management and all that stuff. You're still getting a 20% return on your money for a JV deal.
Whoops. Sorry, Steve. I popped this up here and I forgot. I hit the wrong one. All right. So Mitchell Brown, listen, man, great question. Where can I get this spreadsheet? Email me. It's josh@hardmoneybankers.com. You can play around with this. You probably won't have 50 programs running on your computer all at one time, and it'll be a lot quicker.
Yeah.
But I mean, with the cash flow model, it is really, really vital to buy at the right number. I mean, this all comes back to what can you buy the property at? If this same house, if you buy it today, let's say the average rent goes up to $1,600. You know what the median number in Palmyra is today? It's $239,000.
Right.
So, yeah, I mean, you're talking about 3 years, and nearly $100,000, or I'm sorry, $50,000 in an increase in the median home price. That's pretty significant.
What was our discount here? I just want to do some real quick math here. So it was 178 and then down to 149. Is that what we did there?
Yeah, it's 20% discount, right?
So it's a 20% discount. Here's the deal, guys. I'm a realtor. I list houses all day for everybody. And I tell people the top 10% doesn't exist. If you want to sell your house for $150,000, understand you're going to pay 3% real estate commission to me, 3% real estate commission to the other side. That's 6%, 1% transfer tax. That's 7%, 3% wiggle room someplace.
Yeah.
10% of the deal just disappears right away. 10% of the deal is just fluff and it's just air. So if you are looking to buy properties from somebody because of marketing that you're doing, and you're buying basically good properties, if Josh has a $150,000 house, 10% of that is $15,000. I should be able to, if Josh is motivated at all, talk him down another $15,000. Josh, listen, Just stop and think about it, buddy. We're not going to pay real estate commissions. We're also not going to list it for 2 or 3 months, and then it take another month, for it to go through settlement and stuff like that. So you're not going to be making 2, 3, 5 mortgage payments from the time you decide to list your house to the time you're actually done. You're maybe going to make one more mortgage payment if you sell it to me. That's 2 or 3 or 5 grand right there. Plus just not having the hassle and the headache of having people walk through it and things like that. You don't have to take people from 150 down to 75,000. You just need to get yourself a 10 to 15 to ideally 20% equity position in that house, and you are going to be getting amazing cash flows when you use leverage.
That's exactly right. And the beautiful part of it is that you're buying in a conventional manner. You're putting your 20% down. You're getting your mortgage. You don't need all of this crazy amount of capital to be able to take advantage of something like this. Right. And then 3 years later, when the value is 50% higher, maybe you refinance and you say, you know what, I'm going to take that capital right back out and not have it tied up in the property. I'll buy another one. Right. It's a beautiful thing. All right. So we're running a little bit long. Tomorrow, we have our weekly End of the World show. Where we talk about news and entertainment. There's going to be much less end of the world talk tomorrow than there's been in the past. I think there's some really good news that we're going to be discussing, and you get enough bad news watching the real news. Yeah, I mean, that's all we got for today. Judy, you got anything to add here?
Nope. Call Josh Weidman for all of your hard money needs, and call me to list any residential or commercial rental properties or primary residences. And Josh and I would love to help you out. Other than that, we'll be back here at noon tomorrow. See you, everybody.
Awesome. See you guys.